Time to see what's on Gavin's radar. We are back with Gavin Graham, Chief Investment Officer at Spire Wealth Management. And Gavin, let's start first with First Quantum and First Quantum Minerals, I should say. And why is it on your radar right now?
Indeed. Well, talking about the demand for copper growing because of all these data centers for the AI revolution and the electrification of the auto industry. First Quantum is a major copper producer, about 400,000 tons a year. Its major factor was that the very big mine they had in Panama, the Cobre Panama mine, got shut down a couple of years ago by the Panamanian government, which is a little surprising because it's sort of 5% of GDP and employs 40,000 people. The new government that's come in last year is actually in negotiations with First Quantum. So you get an option effectively on that reopening, which would add several 100,000 tons. But even without that, its operations in Zambia are doing really well. They've opened an extension of their Kanchansi mine, and they also have reduced their debt by doing a $1 billion gold royalty on the gold production from Kanchansi, which makes their financial position look pretty good. So you're up quite a lot this year, I think about 55, 60%, although still below where you were before Cobre Panama got closed down. But again, if you're looking for beneficiaries of the various long-term trends we've been talking about, copper miners are there. You've seen Anglo American taking out Teck, and you saw BHP trying to take over Anglo again for the second time in a year. The people in the mining industry think that getting exposure to copper in politically stable countries with a good record of working with mining companies is a pretty good idea. Okay, let's move on to Cap REIT. What do you like about that? Well, the biggest apartment REIT in Canada. We were talking about how people maybe weren't buying, younger people weren't buying apartments or homes because they got expensive. Interestingly, the growth in the average monthly rental has kept pace with the growth in earnings. So it doesn't cost you any more as a percentage of your income to rent somewhere. And Cap REIT, firstly, has simplified its portfolio. Effectively, it's got rid of almost all of its European exposure in Belgium and the Netherlands and Germany, which is about 15,000 apartments. It's upgrading its Canadian portfolio. Oh, by the way, it sells at about a 30% discount to its NAV, which, given that you get a best part of a 4% yield that's growing gradually, and that whenever it's been at this level of discount, you've generally seen that discount narrow. If rates are to come down further, this looks to be a very obvious play on the continued demand for affordable accommodation in Canada. Okay, and we want to get the last one in here, Canadian Natural Resources, CNQT. Well, here we are, one of the largest oil and gas producers. Murray Edwards has been running it for years and running it very successfully. One of the lowest cost producers, I think their oil sands, it's about $21 a barrel. You've seen the discount between Western Canadian oil price and West Texas narrow because you got the extension of the expansion of the Trans Mountain. If we now get the new pipeline to the West Coast that Mr. Carney and Ms. Smith were talking about, that's obviously good news for someone like CNQ. In the meantime, they've raised their dividend for 25 years in a row. You're getting a pretty reasonable 4 or 4.5% yield. And there's a possibility that they might make more acquisitions because they bought, for example, Chevron's 20% stake in the oil sands operations last year. And Tourmaline has got a big portfolio that's up for sale, which might be something that they'd look to add.